Sitting on home equity and not sure how to use it? Here are your main options, the good and the bad, in 90 seconds. Home equity is the difference between what your home is worth and what you still owe. There are 3 common ways to access it: a cash-out refinance, a home equity loan, and a home equity line of credit, also called a HELOC. Let's start with the upside. A cash-out refinance replaces your current mortgage with a new, larger one, and gives you the difference in cash, often at a lower rate than other options. A home equity loan gives you a lump sum with a fixed rate and a predictable payment, which makes budgeting easier. A HELOC works like a credit card against your equity, so you only borrow what you need, when you need it, and only pay interest on that amount. Now the trade-offs. A cash-out refinance means resetting your mortgage term and paying closing costs on the entire new loan. A home equity loan adds a second monthly payment on top of your existing mortgage. A HELOC often has a variable rate, so your payment can rise if rates go up, and many lenders require strong credit and sufficient equity to qualify. The best option depends on your goals, your rate, and how much equity you actually have to work with. That's exactly why I run the numbers before you decide. Call Matt Walsh with Orca Home Loans at 561-886-8456, and let's see which option makes sense for you.